Hi everyone. So today I'm going to be covering Delta Airlines. I actually covered this company quite a while ago with Abe. It was in I think September of last year, so it's going to be almost probably a year since I covered. But anyway, let's get into it. They've actually made quite a recovery. So let's see what's going on with the company. All right. So as usual, I'm going to check the most recent earnings, which was July 10th of this year. Delta shares jump 11% after airline reinstates 2025 profit outlook as CEO says bookings stabilized. Delta Airlines third quarter revenue, earnings and revenue forecast topped estimates. But Delta expects adjusted earnings to be between $5.25 and $6.25 a share, down from January forecast. So they did revise down, like I said in the previous American Airlines video. And just so we could take a look, bookings have stabilized after a drop in demand earlier this year. Delta shares rose 11%. Delta expects adjusted full year earnings $5.25, 6.25 a share, down from forecast 7.35. So they did revise down. However, an analyst said this 2025 will be the Delta Airlines best year yet. In April, Delta said it could not reaffirm that forecast on again, off again tariffs and hesitant consumer dented bookings. Rival U.S. carriers also pulled their guidance, like I said before. So you do have to keep it aware. And these are just the earnings. So earnings per share, $2.10 adjusted versus $2.05 expected. And then revenue 15.51 billion adjusted versus 15.48 billion expected. Delta, the first of the U.S. airlines to report results for the 3 months ended June 30th, expects adjusted earnings share between $1.25 and $1.75 in the third quarter, compared with Wall Street analysts' forecast for $1.31 a share. It also expects revenue that's flat up to up 4%, topping forecast of 1.4% sales increase. So that's good. And keep in mind, Delta has a partnership with American Express with traveling points and all that. So just to reference it here, there's strong growth for seats like first class and from Amex partnership with which increased 10% in the second quarter of the same period last year to 2 billion. Airlines have become more reliant on travelers who are willing to spend more to fly rather than more price sensitive consumers. So that's good to see. Fares have dropped across the U.S. Premium product revenue rose 5%. Maycam fell 5%. So great to see. Also, there are Delta Sky Lounges, of course. Delta's been working for years to tamp down overcrowding along lines at the Sky Clubs, Sky Lounges. So that's another thing that they're looking into. In the second quarter, Delta posted adjusted revenue nearly 15.51 billion, up 1% from a year ago. Its net income in 3 months ended June 30th, total 2.13 billion, up 63% on the year. Very good. That compares with the net income in the same period, adjusting for per share was 1.37 or $2.10. So again, pretty good earnings, I would say. Just analysts obviously didn't like the revision downwards, just because tariffs, not consumers are more wary. All those things have a factor to play. But let's take a look more in depth with their free cash flow. And their free cash flow, they've made a remarkable recovery since COVID. Uh, it was 17 million in 2021. Now it's 2.3 billion. That's incredible to come from that level, and I believe they were nearing bankruptcy, and they're really becoming more of a cash machine at this point. And we could see here the returns are actually going to reflect that for an airline, pretty good. 5-year return up 114%. I don't think it's beating the S&P, but it's pretty damn close, and it looks pretty good just from an airline perspective. Uh, if you look at the other competitors, I believe they are the best run airline in the U.S. So they do look good in that sense. If we check their free cash flow future growth, like I said, 2.3 billion now. End of 2027, 4.5 billion. So pretty good again, overall, I would say. A double, right? Or give or take. Not exactly 100%, but pretty good, pretty close. Financial health, also not the best, but not bad for an airline. You have a few negatives here. Short-term liabilities do not cover short-term. Short-term assets do not cover short-term liabilities. Long-term liabilities do not. Short-term assets do not cover its long-term liabilities. So again, you don't really like to see this, although the debt has been decreasing significantly and their equity has been going up a lot, but their cash also has been dwindling. So If their cash starts dwindling while their debt starts decreasing as well, if their cash starts increasing and their debt starts decreasing, then it will definitely be more of a buying opportunity, I would say. And their net debt to equity ratio is considered high as well. So just keep in mind of that. The next slide I want to go to is my DCF. So my DCF is Wall Street forecast oriented, and right now it's undervalued by 59%. And I probably would agree with that, just the rate of growth and how they're doing overall. And Wall Street is saying that they're going to go 1%. I probably agree with Wall Street. If you go by historical, it's 36%. I think this is too ridiculous because it's 91% undervalued. I think that's too much. So I would go by Wall Street on this one. And if we check Tipranks here, Tipranks is going to say 13 buys, one hold, 21% upside. I'm just going to reload it again just so everyone sees. So it doesn't look good. I would say that this wouldn't be, if you're interested in airlines, this wouldn't be the worst choice. I think there's still better opportunities, but this is not a bad one at all. Delta's actually looking a lot better recently since COVID, and they have a pretty good future ahead of them. All right, everyone. Thank you.